Hey there, welcome to GeoJesser Explains, the occasional installment of a video in which I explain something I know something about. My last video was the difference between Christmas and Hanukkah, which was it was at the end of November, and this one is something entirely different. This is going to be a little bit of a primer on filing income taxes in the United States. So I think I mentioned in the first installment that this was going to be somewhat eclectic, somewhat whatever I feel like talking about, but always something that I feel like I have enough knowledge and or expertise to make something worthwhile. So hopefully you enjoy this. I know taxes and enjoyment don't usually go together in the same sentence, but hope it's at least interesting and informative, and that you get something out of it. So, filing taxes in the United States, the very, very basics. I have a master's degree in accountancy. And while this topic does not directly relate to geography, which is of course the channel's main theme, it can be useful to understand how taxes work. And even if you don't live or pay taxes in the United States, it may be interesting to you to compare our tax laws to those in your country, or if you do live in the United States but aren't yet a taxpayer, kind of to know what you're in for in the future. Some of the laws here or the information I give may be similar to that in other countries, but I am not educated or trained in the tax laws of any country besides the United States. I should add, none of this should be construed as tax advice, nor is it intended to be comprehensive. I am not your accountant. If you have any questions, please speak with a licensed tax preparer or CPA regarding your specific situation. These are general guidelines. So, if you work a single full-time job and receive a Form W-2 from your employer in January, you don't have any side gigs, hobbies that bring in income, investments, investment properties, or any other source of income aside from your job, filing your taxes should be quite straightforward. However, especially if this is the first time you've done so, there may be some terms and calculations you aren't familiar with or don't know how to apply. That's what I'm here for. Let's start by defining what income tax is. A tax is a compulsory contribution to government revenue that is levied by the government. Taxes are used for hundreds or thousands of purposes, from maintaining roads and infrastructure, to supporting police and fire departments, to the military, to health programs and Social Security, education, social support services, and many, many other things. Some of these are paid for by local and state taxes, while others are paid for all or in part by the federal government. Income tax specifically is a percentage of your annual income that you are required to pay the government. This sounds awful, I know, and I don't know many people who like paying taxes, but it's important to remember that without taxes, the government would have little money to spend on all of the goods and services that benefit the country as a whole. This is not the place to argue about how much government spending is necessary or unnecessary. It is just a place to try to understand what taxes are, how they're calculated, and how much you personally need to contribute. So, first of all, what is a tax return? A tax return is the form you fill out and submit to the IRS demonstrating how much you owe in taxes, how much you have already paid, and whether you owe more or are entitled to a refund. This is commonly called your 1040, which is simply the name of the form that you file. You must send your 1040 either electronically or by mail on or before April 15th of the year following the tax year you are filing for. For example, if you're filing taxes for 2022, you must send your 1040 to the IRS on or before April 15th, 2023. If April 15th falls on a weekend, you get until the following Monday. Lucky you. The first thing you need to know when filing your taxes is what your filing status is. There are 4 categories of taxpayers under federal law. All of these definitions apply to your status as of the last day of the tax year, meaning that if you're filing for 2022, whatever your status was on December 31st, 2022, that is your filing status for the whole year. So if you got married on New Year's Eve, congratulations, you can file jointly for that whole year. Similarly, if you had a baby on December 31st, you get to claim that baby as a dependent for the entire year. Aw, my sweet little last-minute tax deduction. I actually had one. I had a baby born December 17th. So, filing status. A single taxpayer is someone who is not legally married. This might mean you were never married, you are divorced, you are in a domestic partnership, or you are widowed. Although, stay tuned because there's a bit more to it if you are widowed. The next status is married filing jointly. If you are legally married, you and your spouse can file taxes as a single unit, combining all of your income and deductions into one tax return. It is almost always advantageous to both you and your spouse to file jointly if you are legally able to do so. The third type of status is married filing separately. If you are legally married, you still have the option to file your taxes separately from your spouse. There is usually not an advantage to doing so, and if you're watching this, you are probably not one of the rare cases in which it may be worthwhile for you to do so. Finally, there is head of household. If you are not married, but you support one or more dependents, including children, elderly parents, disabled relatives, or a few other qualifying individuals, then you can file as head of household. This is usually advantageous over filing as a single taxpayer. Supporting a dependent means that you financially provide for more than half of their living expenses, including shelter, food, entertainment, transportation, and so on. So if you have a minor child living in your house full-time, they are almost certainly considered your dependent. I mentioned there may be special cases for people who are widowed. If your spouse died during the tax year you are filing for, you typically can still file as married filing jointly. In the 2 years following the death, you can file as a qualifying surviving spouse. But that's a whole other topic. So, once you've figured out what your filing status is, it's time to figure out how much you owe. The next term to define is adjusted gross income. You don't pay taxes on every penny you received as income during the year. Instead, you take all of your income and then apply a few deductions, or in some cases, additions, add and subtract as necessary, and come up with a new number that is almost always considerably less than the number on your W-2. This result is your adjusted gross income, or AGI. Now, you look at the IRS's published tax brackets for the year, and this is where people often get confused about how to estimate what they will owe. So let's walk through it. In the United States, we use what's called a progressive taxation system. This means that the more money you make, the higher percentage of your income is taxed. The taxed brackets define what your tax rate is. Here are the tax brackets for single taxpayers for 2022. If you made less than $10,275 for the year, you pay 10% of that income. If you made more than $10,275 but less than $41,775, your tax bracket is 12%. From $41,775 to $89,074, you are in the 22% tax bracket. From $89,075 to $170,050, or 49, you're in the 24% bracket. The 32% bracket is for those who made between $170,050 and $215,949. The 35% bracket is individuals who made between $215,950 and $539,899. And the highest tax bracket is 37%, which is for those who made more than $539,900 in the past year. This means that anyone from a moderately well-paid lawyer making $600,000 a year to Jeff Bezos are probably all in the same tax bracket, paying 37%. Now, I'm going to explain how these tax brackets work and what they mean using these numbers for single taxpayers. You can find the brackets for the other filing statuses in many places online just by Googling. I'll give you a link to the one I used for this in the description below. You'll notice that for married taxpayers filing jointly, the income ranges are essentially doubled for the same tax rates. That's why it's almost always advantageous to file jointly. For head of household, the brackets are higher, but not doubled. And if you're married filing separately, they're the same as the single brackets, except for in the highest levels. Many people think that if they're in the 22% tax bracket, that means they're going to pay 22% of their income or their adjusted gross income in taxes. But this is inaccurate. Rather, you pay 10% of the amount up to the upper range of the 10% bracket, then 12% of the next amount up to the upper range of the 12% bracket, then 22% of the amount from the upper limit of the 12% bracket to your AGI. Fortunately, you do not have to do all that math yourself. The IRS provides the numbers you need to use. So, if you're filing singly and you are in the 22% tax bracket, you will owe $4,807.50 plus 22% of the difference between your AGI and $41,775, which is the upper limit of the 12% bracket. So let's say you figure out your AGI and it's $54,600. The tax you owe would be $4,807.50 plus 22% of $54,600 minus $41,775, or $4,807.50 plus 22% of $12,825, which is $4,807.50 plus $2,821.50. So the total tax you would owe for the year is $7,629. That's a lot of numbers. That's why I kind of wrote it out for you here. Some people, that math is easy right off the top of your head. Other people are completely baffled by it. So hopefully that makes it more clear. Notice that if you actually were paying 22% of your AGI, you would owe $12,012, which is considerably more than what it works out to using the tax brackets correctly. You can use this final amount to figure out your effective tax rate, which is the actual percentage of the income that you owe. You do this by dividing the amount you owe by your AGI and then multiplying by 100 to get the percentage. In our example, the individual's effective tax rate is 13.97%, or about 14%, not 22. The good news is most tax software will do all of these calculations for you, but I still think it's important to understand where the numbers come from so that you can have a rough idea of what you may owe and how your situation will change depending on if you make more or less money in the coming year, if your marital status changes, if you have a child, and so forth. So, now that you've figured out how much you owe, what do you do with that information? Well, if you're an employee who receives a W-2 form from your employer, then that form will also show how much your employer withheld throughout the year. Employers are required to keep a portion of your salary or wages in a separate account and send that money to the IRS on a quarterly basis. You will have filled out a form called a W-4 when you were hired, in which you tell your employer how many dependents you have. Using this information, the payroll department will estimate how much you will owe in taxes based on your current salary, divide that by the number of paychecks you'll get, and withhold the appropriate amount from each check. The amount reported on your W-2 will show how much was withheld for the whole year and sent to the IRS on your behalf. If this amount is more than what you've calculated that you owe, then you're entitled to a refund. The IRS will send you back the money you overpaid. If, however, the amount withheld was less than what you owe, you'll have to send a check to the IRS for the difference. If you don't pay the amount you owe by April 15th, you may be responsible for additional fees, such as late fees and interest. And no, the IRS will not come knocking on your door on the 16th and arrest you. That is just not what happens. People are so afraid, but really, they give you a lot of time to correct mistakes. You should know that in addition to the federal taxes withheld from your paycheck, your employer is required to withhold state income taxes as well. The amounts and procedures for state income tax varies by state, so I can't get into all of that here, but most states use the AGI that you've calculated for your federal income tax as the AGI for your state taxes as well, so you don't have to do all that math again. Your W-2 will also show how much was withheld in state taxes. In addition to all of the income tax, everyone is required to pay Social Security and Medicare taxes. Combined, these are called FICA taxes. These taxes fund those social services that you will eventually one day benefit from. 6.2% of your gross wages go to Social Security and 1.45% go to Medicare, on top of the regular income tax that you pay. Your employer is required to match these percentages, in addition to some other taxes employers have to pay, so that the total amount received by the government is 15.3% of your income, though you are only responsible for half of that, if you are an employee. People who are self-employed, work as freelancers, gig workers, and so forth will have to pay the full 15.3% of any money that comes in from those sources, so be aware of that when thinking about your tax situation. This applies to YouTubers who make money on their YouTube channels, just FYI. So let's talk about the difference between a tax deduction and a tax credit real quick to close out this basic introduction to paying your taxes. A deduction is an amount of money you can subtract from your income before you calculate your tax. Every taxpayer is entitled to the standard deduction, which is a fixed amount based on your filing status. For example, the standard deduction for a single taxpayer in 2022 is $12,950. This means that no matter what, you can subtract that amount from your income before calculating your taxes. And often, once you've applied all of your deductions, you'll end up in a lower tax bracket than before, which will considerably reduce your taxes. Now, if you have other deductions that will, combined, add up to more than the standard deduction, you can use that amount instead. Common deductions include the interest on your home mortgage and student loans, property taxes, IRA contributions, and charitable contributions. Tax credits, on the other hand, are amounts of money you can subtract from the tax that you owe. So, regarding our example above, what if our single taxpayer paid for their own school tuition that year? They may be eligible to receive an American Opportunity Tax Credit of up to $2,500. This would reduce the amount of tax that they owe by that amount. So instead of the roughly $7,000, they might only owe $5,000. The American tax code is very long and very complicated, but most individuals paying their personal taxes don't need to worry about most of it. A lot of it applies to employers, businesses, corporations, big investors, and so forth. However, it's important to know the correct terminology and to understand the basics to make sure you're filing your taxes correctly and that you're not overpaying. While I firmly believe everyone should pay their fair share, I very much do not think you should pay more than you have to, especially for those in the lower and middle classes who already contribute so much to the United States economy. Let me know if you have any questions. I'll do my best to answer them or to direct you to resources. Again, I am not your accountant. This is not tax advice, but I hope that it was informative. Maybe you learned something. Maybe it clarified something for you. Shout out to my patrons, especially my Explorer tier patron, Shannon, for their ongoing support. It is very much appreciated in these hard times. If you would like to join my Patreon, you can join for as little as $1 a month, and you get access to perks like bonus videos. And if you spring for the Explorer tier at $5 a month, you also get priority consideration for word suggestions, as well as access to my exclusive vlog. So check that out, and I will see you, hopefully, on the next edition of GeoJesser Explains.